Hello folks, welcome back. This is our weekend commentary for the ICT Mentorship, July 10th, 2021. This is my youngest son's birthday today, so I was going to do this video last night for Friday, so that way I would have the weekend to myself and my family, but my youngest son decided he wanted to do something for his birthday a little early, so there it is. Since I'm not technically obligated to you on Friday, that's the reason why no video was posted yesterday. So in case you're wondering, there it is. So we're doing Sunday's video that you've been normally getting today. Okay, so it's Saturday, July 10th, 2021. This is the weekend commentary for the ICT Mentorship. So here's our daily chart for the dollar index. And I want to talk a little bit about market structure, changes in market structure, and when it is useful to anticipate or even consider whether or not market structure has in fact been affected. The last video we did, I said we would stick with the assumption that we'll see if it wants to trade higher and complete this volume imbalance. And on Thursday, we only seen it trade right back to the discount low of the gap over here. It broke lower, and I'm thinking at this moment, we have a volume imbalance down here. What's that? Relative equal lows. This low is slightly higher than this one. So we have a sell side liquidity pool there and volume imbalance. So if we see this thing continue to drop, be mindful around that 91.40, 91.45 level or thereabouts. All right, so let's get into the nuts and bolts of this thing here. This is the daily chart zoomed in. Again, you can see how it trades up into the discount low of that gap. Trades below this candle's opening right there. Then comes back up on Friday, hits this as your bearish order block, and then begins to expand on the downside. We have a short-term sell-side liquidity pool there inside of an old imbalance, so just be mindful of that. And then here's the volume imbalance I was drawing attention to before we zoomed in, and the relative equal lows. Dropping down into the hourly chart on dollar index, you can see again the volume imbalance on the daily chart. That's what these levels are here. The premium high, discount low, consequent encroachment, which is the midpoint of that imbalance. And then we have the gap. Trade up into it, and then hit it as resistance on the discount low. And then on Thursday, on the 8th, notice we had a drop lower than this short-term low here. We'll talk a little bit about that in a moment. But this is that daily bearish order block level. Okay, so this is the level that you can see it trade back up into on Friday, and then starts to trade lower below this low, and then trading down into this short-term low. If you take note inside of this fractal, that down close candle prior to this run up, so in other words, we had this short-term high in place, this short-term low, and then we made this high at the gap, and then on Thursday we broke down below that short-term low, and then we traded back up into the daily bearish order block, which is that red level, and then we have this down close candle, which is the breaker. The breaker is part of this overall structure. So we have buy side liquidity here that was taken there, and then we had a market slide below the short-term low, and then we turned back to the breaker and the daily bearish order block level on Friday that set the stage for lower prices. So we had this little bit of a run up into as a Judas swing overnight on Friday, then displacement on the downside. Notice when we had this low broken here, that's a change in market structure. So it changes from bullish to bearish. Now, go back to the last video, and I mentioned that we would stick with the assumption that maybe the dollar might want to complete this on Thursday. But Thursday is what day of the week? That's the day that generally caps the weekly range. Now, when it doesn't, Wednesday could always be a factor. Now, here's one of the takeaways from this lesson today, because we're talking about weekly profiles, completing PD arrays. In other words, we traded up into a premium array that we were anticipating as an upside target. We were inside the volume imbalance, then we noted the gap, and then we have all of these signatures completing consequent encroachment. The question is where does the interbank algorithm change its state of delivery from bullish to bearish? Yes, we've seen the break in the market structure there, but when does the algorithm actually change its state of delivery? Last up closed candles. Notice this candle's close is higher than this one over here. Even though this one wicks through, this is the order block. These 3 consecutive up closed candles, that is your bearish order block. The opening price there, if price trades below that, which it does right there, that is exactly when the change in the state of delivery occurs. So we had a bullish delivery, and then it becomes bearish right there at that moment. That right there is what makes the order block an order block. It's not just an up closed candle or a down closed candle like all these yahoos on Instagram, YouTube. Everybody wants to say it like they're informed, but they have no idea what's going on. Zero. But this change in the state of delivery, the algorithm is now changing gears and now moving the price lower. Not buyers coming in or sellers coming in and influencing the market because of their pressure. That's not what this is. It's the changing of the state of delivery, which occurs right there. Now, that's not the only one. You have a secondary one right here. So we have an up closed candle, again, prior to this decline. So this is your bearish order block. This is your bearish propulsion candle. Okay, so this propulsion block eats into this bearish order block, and then we have a change in the state of delivery again, right there. Now, when that occurs, yes, we have a fair value gap there that can come back up and trade into that, but it's not likely to. And you have to have 2 procedures that begin at that moment. Always anticipate the likelihood of this coming back up into fill, but I'll show you what you have to do in terms of hierarchy for logic. Okay, so from a programmer's stance, and also how the algorithm will refer to these PD arrays, this could always be a bearish order block that's traded back up into. But all of this narrative here will cancel that out in a moment as I go back through with you. So the change in the state of delivery going lower begins right at that opening price on this candle. As soon as it trades through it, now the algorithm is delivering on a sell side. So basically, the algorithm enters a sell program. Once this occurs, price will start to go lower, attacking what? Any imbalance or sell side liquidity. Now, looking left of this opening price, where is there an imbalance? Because it's already seen it trade down, came back up, and then we came down again, and came back up again, and then left it. So it's not coming down to get an imbalance. It's going down here for liquidity, sell side liquidity. But now that run on the sell side liquidity coupled with the PD arrays that's been complete up here, and we have changes in the state of delivery, we can refer to this opening price and this new low. This right here is an IPTA data range for dealing. So in other words, an IPTA dealing range. So we're looking at the opening price down to that low, trades back up into that daily bearish order block, and sells off. Opening price on this bearish order block, drawn down to that low. I only extended it over to the right, so that way you can see how it trades up into optimal trade entry. So at the 62% retracement level there, we are definitely inside of a premium relative to this opening price and that low. So it trades back up in. Now, if you pull a fib from, say, this high to that low, you do not get an optimal trade entry. But I taught you recently using where the market changes its day of delivery. If you put your fib there and anchor it down to your swing low or up to your swing highs, you'll see the Fibonacci's line up perfectly for optimal trade entry, which is why it is dubbed optimal trade entry. It's not the golden zone, okay, where everybody knows about the 79% retracement level and the 62% retracement level. That's not the magic. The logic is understanding that we had a breaker over here that completed at a premium array. We gave it the possibility, or anticipated it rather, continuing on Thursday, and then maybe Thursday creating the high of the week as it trades up into the remaining portion of that volume imbalance premium high. But it didn't do that, and we'll come back to that in a moment. Now we're going to look at the secondary change in the state of delivery, which is this low here at the opening price. There. When it creates that up close candle, draw your fib from that down to the low, same thing. You get essentially the 70.5 level, but optimal trade entry nonetheless. Market breaks away from that optimal trade entry and daily bearish order block. Breaks lower. We have another change in the state of delivery there, which is also what? Bearish order block. So once the market starts to break down, yes, it can always come back up into that level, but not if we have something like this. We have the up close candle down. It leaves that order block. Then the next candle here, we open and trade back up into it immediately. So this very quick return back into the bearish order block, in my mind, cancels any necessity for it to come back up to it again, because what is this candle? We have the bearish order block and then this. What is this? That's a propulsion block or propulsion candle. It's eating into essentially half or less than the bearish order block. Immediately as soon as you see that, right after that candle is usually when the big move of repricing goes lower. Look at the signatures in this one as well. We have the up close candles, which is all consecutively one bearish order block. The market trades into it again here, essentially about halfway there. Once this candle closes, you remember how sometimes I'm looking at certain trades I'm in, or I'm doing exercises and I'm recording, or I'm calling out in text what the market should do. I'm anticipating range expansion now. Often it's after the propulsion block. Now you know what I've been doing in some of these instances where I'm anticipating range expansion. I'm expecting big ranges. It's going to take off and start moving in my direction because it's all based on the propulsion block. Okay, so we have this candle here. Immediately what happens? Boom, the big move begins. Here, bearish order block, propulsion candle, boom, the big move begins. Okay, you see how that works? So now that is reversed, obviously, for anything that would be a bullish market. Propulsion blocks are essentially a timing mechanism for me and all other interbank traders to know when the big move is going to begin. So if you've missed it, you pretty much, you're done. You got to use either a institutional order flow entry, or you let it go. You don't chase it. Because as far as that move is done in terms of an order block, propulsion, that's why I dubbed it propulsion, because it propels price away from the original order block. Propulsion block repels price away from the original order block. This is smart money entry. This is low risk short. Same thing with market maker sell models. Smart money reversal, selling in that candle. Low risk short. Boom. Takes off. Okay. You're learning some good stuff here today. So we have a bearish order block level here. We'll look at this when we drop into the 15-minute time frame. But the market drops down into the last down closed candle, the high and the fair value gap. It closes in both. Look at the bodies respecting that handsomely. So from displacement here to here, that's opportunity. So if we're looking at the dollar index, this translates into buying opportunities for euro and cable. If we understand that there is always room to see it continue on Thursday, but what happens that changes your mind or changes your analysis to no longer anticipate that completing or some other continuation on the upside? The fact that we have broken key lows here that were prior to this run up into this high, into a premium array that we were looking for, and then it breaks down. Day of the week, crucial. Okay, and we'll talk more about that in a few minutes. Dropping into the 15-minute time frame, okay, you can see that same daily bearish order block level and the hourly bearish order block level, and we see the market trade back up in and then breaks down. So we have what occurring again? A fractal formation of what we've already shown on the hourly chart. It's just being shown on a 15-minute time frame. We have a sell side liquidity pool here, then the hourly 60-minute fair value gap levels down here. London open kill zone, 2 a.m. to 5 a.m. This candle right here trades up into optimal trade entry. Right in here, trades up optimal trade entry at 5 a.m. Displacement to the downside. Now, I want you to look at this hourly chart and think about day of the week, weekly profile, and key turning points, key highs and lows. Here's Monday's trading. We trade down. Tuesday makes the low of the week. So it changes gears, goes higher. And then on Wednesday, what happens? We see it trade up into the gap on the daily chart. And then on Thursday, we are assuming it could potentially go higher into that completion of the daily volume imbalance premium high. But look what it does immediately after midnight on Thursday. It breaks lower. Now, what is the rules for Thursday? Generally, Thursday at 7 a.m. to 10 a.m. can classically cap the weekly range. So in other words, if we're seeing the low form here on Tuesday, which is what you learn here, if you're bullish on the week 70% of the time, Tuesday will create the low of the week. Well, here we go. So it creates the low of the week. It rallies. We're bullish. We're looking for higher prices. And then we anticipate continuation on Thursday. That's our analysis. But we have to use what information is given to us by IPTA. So IPTA does what? It reprices at midnight on Thursday aggressively. Now, are you buying anything down in here yet? No. We would rather see something like it rally up, create a fair value gap, come back down, and then run to the completion of that premium array or volume imbalance premium high. This shows us that it's immediately repricing lower. It breaks this short-term low and it breaks this low here. So we take out Wednesday's low. Well, how's that translate into the weekly range idea of Thursday? We can't be a buyer in Thursday because it's already breaking market structure after creating a run into a premium array. And Thursday is generally likely to cap the week. In other words, put the opposite end of the daily range in. Now, if we break down overnight, like we're seeing here, this is many times, 80% of the time, canceling out a higher run on Wednesday, and then Wednesday becomes the high of the week. So the weekly profile is consolidation, low of the week on Tuesday, rallies Wednesday, breaking structure, be a short seller on Friday. Assuming you have range opportunities over here to work with. And we'll, again, counsel you to go back through the video and you'll see those things I just discussed. But we have no real bullish scenario here because we're breaking structure and no imbalances are there. So if it's going lower and we're doing it ahead of New York, we can't be a buyer in New York. And we naturally revert back to Wednesday's now probably the weekly high. So sit on your hands, wait till Friday, and see if you can get a short using the breaker and all the things I've outlined in this teaching. So there's your turning points there without any graphic annotations. And you can see the turning point here and the turning point here. Now, we were looking for a run up into here, but we were allowing for Thursday to give us more upside. and it immediately gives us this. This is it telling in the marketplace that it's not likely to do that, and we have a break in market structure. Go back to the breaker logic, and there it is for Friday. Moving right along, here is the Eurodollar daily chart, and we have a propulsion candle after hitting this bearish order block, propulsion candle right here, trade into that, moving higher. Now, should we take out this short-term high and gain momentum, we have buy-side liquidity resting up here in a small little remaining portion of this imbalance up to this candle's low. And then we may get some kind of a bounce, lower. Does it completely turn around and go lower? That remains to be seen. Does it even get up here? That also remains to be seen. But seasonally speaking, foreign currency usually rallies about now, and dollar usually tends to get some weakness. So we have all of this range in here. Should it get wildly bearish for dollar and we resume our bearish stance on the greenback, we could see all of this range in here revisited as well. Down close candle in here, opening price and the high, those levels are being shown here, and they'll be detailed on the lower time frame. So just make sure you draw a mental note on where these dark blue lines are, and then the original fair value gap levels here are in gray. So just make sure you understand the lay of the land before we drop down in the lower time frame. Here is the hourly chart on euro. Remaining buy-side liquidity resting here on near term, so it could reach up into that. Small little imbalances in here, so they could be revisited on Sunday, Monday, and then maybe send us up into that buy-side liquidity. The daily bullish order block high and the opening price, that's what these blue levels are. And after taking sell-side liquidity out, down into the propulsion block, we rally up, retracement in, using this range here to here. You can see we do trade into an optimal trade entry, but we'll actually break it down even further. Market structure changes when this high is broken there, and what also resides the breaker. Last up close candle, extend that through because we are not supply and demand. Trading into the daily bullish order block and hourly breaker that's bullish right there, and sends price higher. 15-minute time frame, transposing all of the things that this had on the hourly chart, the breaker and the daily bullish order block levels here, the propulsion block sending price higher, and the remaining buy side liquidity pool resting up here for upside, draw on liquidity. Inside the London open kill zone, right there at 5 a.m. Last down close candle, order block. Moving on to British pound. Last down close candle. Unwilling to make another revisit to that level or go lower. Bearishness on the dollar, it broke down, so that gives the green light for cable to rally on the upside. Be mindful of the balanced price range because that might be influential going forward, but if it trades through it, we're looking for this rebalance right in there. British pound hourly chart. You can see that we had the original sell side liquidity here. It traded through that on Thursday, went lower, failed to go lower on Friday. Bullish order block here on Thursday's trading. Failure to go lower, did go through rejection block, which is the lowest down close candle here. Then went higher, came back to the old low there. Reprices higher above the short-term high, then trades back down into what? What is this candle right here? It's a breaker, and we have a buy side imbalance, sell side inefficiency. Which brings me to a question I got from a new student. Now, I've covered this when I talk about imbalances and buy side imbalances and sell side imbalances and fair value gaps. A BISI, which is a buy side imbalance, sell side inefficiency, or a SIBI, sell side imbalance, buy side inefficiency, they are both by classification an imbalance in price. So by definition, it is a fair value gap. That is further divided into what type of gap. Is it a buy side or sell side gap? So SIBI and BISI are just classifications of a fair value gap, which is by nature an imbalance. So the hierarchy is price imbalance, specifically fair value gap, which is subdivided into two categories. It has to be one or the other. It can't be a fair value gap that does both things. It's, in this case, this is a fair value gap, but it's in the form of a buy side imbalance, sell side inefficiency. It's a single candle running higher. So it's buy side imbalance, too much buy side offered too quickly. And it's inefficient in offering sell side, which is why I call it buy side imbalance, sell side inefficiency. So this is a buy side imbalance, sell side inefficiency fair value gap. When I'm classifying ranges like this on the chart, if it's large like this would many times be annotated as a SIBI, but it's still a fair value gap. This could be easily categorized as a BISI, or I could have FVR next to it. The distinction is the buy side or sell side inefficiency, because the imbalance itself is going to be determined by the direction of the candle that makes that one single pass. So if it's an up candle, it's always going to be basically a buy side imbalance, sell side inefficiency. And if it's one single candle like it is over here, between this candle's low and this candle's opening, this is a SIBI, sell side imbalance, buy side inefficiency. But both are fair value gaps, and by their very nature, imbalances in price. Okay, so there shouldn't be any kind of confusion, because sometimes I use these terms interchangeably, and it may, and I'm not trying to do this on purpose to confuse any of you, because I've actually talked about this. This is the first time I said this, but I've said it in various places, and I can't recall exactly where I said the very things I'm saying right here. But I'm doing it in very clear terms now, so that we understand that fair value gap is the same as the buy side imbalance, sell side inefficiency, or sell side imbalance, buy side inefficiency. It's either or. In other words, a fair value gap, okay, that's a gap in price. But what is it indicating? Is it an imbalance on buy side, or is it an imbalance on sell side? Buy side imbalance, because it's an up candle. Sell side imbalance, because it's a down candle. Okay? Hopefully that's answered your question, and you know who you are. So if we continue that out in with the breaker here, we have an overlap of the buy side imbalance, sell side inefficiency being retraded back into, and the breaker, because we have a low, high, lower low. Yes, there's all kinds of smaller little ranges in here, but this low can't be used because the high is formed prior to that low. So the low prior to this high forming is this low. So it's low, high, and then lower low than we've seen here, because this high gets broken on this pass with this buy side imbalance, sell side inefficiency. So we have a lot of things converging here to pick up orders around very close to that 138.20, but we do see it trade down into 38.25. It picks up orders and rallies. It's not picking up orders and those buyers sent price higher. It's trading back down so those individuals that are aware can be a buyer here. If they miss their buy, it is what it is. But it wasn't buyers that sent it from here to here. That's repricing by the algorithm, attacking the buy side liquidity. And keeping those things on our chart, but just dropping down into a 15-minute time frame. Here is the pound dollar 15-minute with the breaker shown here and the BISI and the order block it trades off of. And we'll clean all this up now. So we have a 60-minute fair value gap here, and we have the order block here, which is all of these consecutive down close candles. We trade above it and then come back down in. So we're digging back down into this overall order block here. When is it occurring? Well, let's zoom in here and put some more details on this. So we have the London Open kill zone right here, 2 a.m. to 5 a.m. This candle right here creates that short-term low. If you look very close, here is the change in the state of delivery from this candle's opening. Once we see it cross over there, draw it up to the high. Here's your optimal trade entry levels, extended out in time. You can see we do trade down into OTE right there. And at 5 a.m. then begins the buy program, which is the opposite of what we saw in the dollar index. So I covered a lot of things in here. I talked about when does a market structure valid and when would you anticipate them? Well, you have to see them trade to a key PD array. So in other words, it just can't be, oh, it broke a short-term low, so there's a break in market structure. No. Did it complete a premium array? Did it trade up for some period of time and then reach an objective that we have been looking for? Once it does that, and then you see market structure break, then also refer to the day of the week. Does it fit in the weekly profile protocols that I teach you? And then you can build all those things out to flesh out a market model based on the fractal that's in the marketplace at the time, like I did for this video here. And that, my friends, is going to be it for this weekend. I will touch base with you again next week. Until then, be safe.